Hello future homeowners, welcome back to our channel. I'm John Werner with Mortgage and Credit Pro, where we break down the mortgage steps in home ownership to make your journey smooth and stress-free. Today, we're diving into the top 12 questions home buyers commonly ask about the mortgage process. Whether you're buying your first home or want to refresh, these answers will help you feel confident and prepared. Let's start with the basics. A mortgage is a loan you take out to buy a home. It's a financial agreement between you and a lender where you borrow money to purchase a property and agree to repay it over time, typically 15 to 30 years with interest. There are several types of mortgages, including conventional loans, which are ideal for borrowers with good credit. FHA loans, backed by the Federal Housing Administration, are great for first-time home buyers with those lower credit scores. VA loans for eligible veterans and active military members. No down payment options are offered. USDA loans are designed for buyers in rural areas. Jumbo loans are for higher priced homes exceeding conventional loan limits. Understanding these options is key to finding the right loan for your needs. Now let's go over how much I can afford. Your budget depends on your income, expenses, and how much you've saved for your down payment. Lenders typically use your debt to income ratio or DTI to determine how much you can afford. A good rule of thumb is to keep your total housing cost, mortgage, taxes, and insurance below 47% of your gross monthly income. Now, what's the difference between a prequalification and a pre-approval? A prequalification is an initial estimate of how much you can afford based on basic financial information you provide. Pre-approval is a more in-depth process where the lender verifies your income, assets, and credit, giving you a more accurate loan amount. Sellers often prefer buyers with the pre-approval because it shows you're serious and financially prepared. Let's look at what you will need for a down payment. Down payments can range from 0 for VA and USDA loan, 3.5% for FHA, and 5% for conventional loans. The amount you need depends on the loan type and financial situation you're in. Larger down payments can lower your monthly payments and help you avoid private mortgage insurance, also called PMI. Closing costs include fees for appraisals, title insurance, inspections, and more. These costs typically range from 1.5% to 2% of the home's purchase price. Be sure to ask your lender for a loan estimate early to see an itemized list of these expenses. Next, what credit score do I need? Credit scores requirements vary by the loan type. Conventional loans typically require a score of 620. FHA loans allow scores to 580 with 3.5% down. VA and USDA loans typically require a score of 580 to 620. The higher your credit score, the better your interest rate will be. So it's worth improving your credit before applying. Now let's go over what the interest rate and APR are. The interest rate is the cost of borrowing money, while the APR, or annual percentage rate, includes the interest rate and additional fees. The APR gives you a complete picture of the loan's cost, so you can compare both of them when shopping for a mortgage. Now let's go over the documents you will need to be able to apply for a mortgage. Pay stubs, W-2s, or tax returns if you're self-employed, bank statements to show your savings and other assets, documentation of any other income sources. Having these ready will speed up the application process. PMI is required if your down payment is less than 20% on a conventional loan. It protects the lender in case you default on the loan. FHA loans have their version of mortgage insurance, MIP, which applies regardless of your down payment. Now let's go over how long the mortgage process takes. The mortgage process typically takes 30 to 45 days from application to closing. However, it can vary based on factors like how quickly you provide documents and the complexity of your financial situation. Staying responsive to your lender's request can help you keep things on track. And now the last question, can I pay off my mortgage early? Yes, most mortgages allow you to pay off your loan early through extra payments or a lump sum. However, check for any prepayment penalties in your loan terms. Paying off your mortgage early can save you thousands of interest over time. These are the top 12 questions homeowners ask about the mortgage process, but there's always more to learn. If you have additional questions or need guidance tailored to your situation, don't hesitate to contact us at Mortgage and Credit Pro. If you found this video helpful, give it a thumbs up, subscribe to our channel for more mortgage tips, and share it with anyone who might benefit. Thank you for watching, and here's to making your dream of homeownership a reality.